Right now, the market is sending a very powerful signal, but most people are still not paying attention. What looks like normal price movement on the surface is actually part of a much bigger shift happening underneath. And on gold-silver scope, we simplify these complex signals so you can clearly see where things are heading. Let's start with gold, because everything begins there. If we study history carefully, gold has shown a very consistent pattern across major cycles. After every major bear market low, gold has delivered massive upside moves. Not small gains, but exponential growth. For example, after one major low, gold moved nearly 8 times higher. Then again, after another cycle, it repeated the same type of move, another 8-fold increase. This is not coincidence. This is a pattern. Now think about this carefully. The last major low for gold was around 2015. If we simply apply the same historical pattern again, it suggests a potential move toward the 8,000 to 8,500 range. And this is not an extreme prediction. It is just repeating what gold has already done twice before. That's the key idea. We are not talking about something new or impossible. We are talking about something that has already happened multiple times in history. And now the conditions are even stronger than before. Because today, the global financial system is under much more pressure. Debt levels are higher, money printing is larger, and economic uncertainty is increasing. These are exactly the conditions where gold performs best. So when people say gold at 4,000 or even 5,000 sounds too high, they are actually missing the bigger picture. Compared to previous cycles, those levels are not extreme at all. In fact, they are still below what history suggests is possible. At the same time, while gold is building its long-term move, silver is expected to move even faster. There is growing expectation that silver could reach the 300 to 500 range, possibly in a much shorter time frame. And the reason is simple. Silver always plays catch-up, but when it moves, it accelerates aggressively. Now let's talk about something very important that most investors misunderstand. Recently, we saw gold, silver, stocks, and even bonds all moving down together for a short period. That confused many people, because traditionally, portfolios are built on the idea that when stocks fall, bonds will protect you. But that old model is starting to break down. The idea of a safe 60-40 portfolio, 60% stocks and 40% bonds, is no longer working the way it used to. Bonds are not acting like a safe hedge anymore. Instead, both stocks and bonds are showing weakness at the same time. So what is actually acting as a true alternative? The answer is precious metals. Even during recent volatility, when markets looked unstable, gold and silver still managed to outperform. In fact, over a recent period, metals and mining stocks were up around 7 to 8%, while stock markets were down by a similar amount. That is a clear divergence. On the surface, everything looked weak. But underneath, precious metals were actually gaining strength. This is a major shift. It shows that metals are no longer just reacting to the market. They are leading in certain conditions. And this usually happens when deeper monetary forces are at work. Because at the end of the day, gold and silver are not just commodities. They are money. They respond to changes in currency value, liquidity, and central bank policies. And right now, those forces are becoming stronger than ever. So what we are seeing is not just another cycle. It is the beginning of a structural shift. A shift where traditional assets may struggle, and real assets like gold and silver start to take the lead again. To understand why this shift is happening, we need to focus on the role of central banks and economic cycles. Because the real driver behind gold and silver is not headlines, not short-term news, but long-term monetary policy. Here's how the cycle usually works. First, markets start to weaken. Stock markets begin to roll over slowly. At this stage, economic data still looks stable. Unemployment appears fine, production numbers look okay, and everything seems under control. But then, as markets continue to decline, the real economy starts to feel the pressure. Employment weakens, industrial output slows down, and consumer demand begins to drop. Only after this happens do central banks react. This is very important. Central banks are always late. They do not act before the problem appears. They react after the damage has already started. And when they finally step in, they usually do it aggressively. They cut interest rates, inject liquidity, and try to stabilize the system. And this is where gold and silver benefit the most. Because when money supply increases and interest rates fall, the value of currency weakens. And when currency weakens, precious metals rise. Right now, we are starting to see early signs of this cycle forming again. Markets are showing weakness, economic signals are slowly turning negative, and expectations are building that central banks may soon step in with supportive policies. Another important factor is mining profitability. Many people assume that rising energy costs, like oil prices, will hurt mining companies. But when we look at the data more carefully, that argument does not hold. Yes, energy costs may rise, but compared to the price of gold, those costs are still relatively low. In fact, historically, the cost of oil relative to gold is much lower today than it was in past cycles. This means miners are still highly profitable even with higher energy prices. And this is why mining stocks have strong potential. If gold and silver prices continue to rise, mining companies can generate even higher profits. And that often leads to strong performance in their stock prices. Now let's return to silver, because this is where things get even more interesting. Silver is currently undervalued compared to gold. Historically, silver used to trade at a much higher percentage of gold's price. But today, that ratio is still very low. If silver simply returns to its historical average, it would need to rise significantly relative to gold. And if it overshoots, which markets often do, the upside becomes even larger. But silver has another advantage: industrial demand. Unlike gold, silver is heavily used in industries such as energy, electronics, and technology. And right now, demand for silver is stronger than supply. For several years, production has not been able to keep up with consumption. This creates a supply deficit. And when demand exceeds supply, prices naturally move higher over time. So silver has two powerful drivers. It benefits from monetary demand like gold, and at the same time, it has industrial demand pushing it higher. This combination makes silver one of the most powerful assets in the current market environment. And when we add mining stocks into the picture, especially silver miners, the opportunity becomes even more significant. Because historically, these stocks can outperform both gold and silver during strong bull phases. So what we are seeing is not just a simple rally. It is a multi-layered opportunity driven by monetary policy, supply-demand imbalance, and long-term valuation shifts. Now let's bring everything together and focus on what this means going forward. We are entering a phase where traditional market assumptions are starting to fail. Stocks are no longer guaranteed to rise, bonds are no longer providing safety, and economic stability is becoming more uncertain. At the same time, real assets are beginning to reassert their importance. Gold is setting the foundation. It is acting as the core monetary asset, reflecting the weakening of currency value over time. And based on historical patterns, even a normal cycle could take gold much higher from current levels. But the real acceleration is expected in silver, because silver is still undervalued, still catching up, and still supported by both monetary and industrial demand. If the gold-silver ratio starts to normalize, silver could see explosive upside. And beyond that, silver mining stocks could amplify those gains even further. We are also seeing a broader shift in commodities. For years, commodities have been undervalued compared to stocks. But now, that trend is starting to reverse. As liquidity increases and capital rotates, commodities are beginning to rise again. Even in weak economic conditions, this can happen. History has shown that during periods of stagflation, slow growth with rising prices, commodities and precious metals can perform very strongly. So the idea that recession automatically means lower prices for metals is not always correct. In fact, in many cases, the opposite happens. This is why understanding the bigger cycle is so important. Short-term news can create noise, but long-term trends are driven by deeper forces like money supply, valuation, and capital flow. And right now, those forces are aligning in favor of gold, silver, and commodities. If you want to stay ahead of these major moves and understand what's really happening in the market, make sure you follow Gold Silver Scope, where we break everything down into simple and powerful insights. And always remember, this is not financial advice. Markets involve risk, and you should do your own research before making any investment decisions. The opportunity is forming, but only those who understand it early will be able to take full advantage.